Part 2, Crypto Research Report 2020. This report assumes a stable velocity of each coin over the next decade. The velocity figure is calculated based on the 2019 on-chain velocity of each coin. Velocity is calculated by dividing the annual trading volume in dollars by the network's on-chain transaction volume and then taking an annual average for 2019. A more in-depth analysis would try to forecast the average amount of hoarded assets each coin will have each year. Hoarded cryptoassets pull down each coin's average yearly velocity because they have a velocity of zero. As previously mentioned, the 57% of Coinbase users who held their Bitcoin in 2016 had a velocity of zero. Coins that incorporate staking such as Dash also need to have their velocity adjusted because staked coins have a velocity of zero. Target addressable market (P) is the average price of goods in the economy. With regards to currency, utility, and stable coins, the price is the cost of the good or service being provisioned. Q is the quantity of goods in the economy. The total global demand for cryptoassets, PQ, is calculated by determining the size of each target addressable market, TAM, for each coin for each year and what percentage of the TAM will be penetrated by the coin each year. In 2012, I paid 5 BTC for 1 pound of coffee beans. The coffee wasn't good. Everyone in Bitcoin has had a pizza day spending moment. Some of you just haven't realized it yet. Andreas Antonopoulos, May 2020. However, not all use cases can be served by all coins. So, first we have to distinguish between 4 types of coins. A store of value coin is defined as a distributed ledger technology that can be used to securely store value over time. Currency coins often don't have Turing-complete protocols that enable sophisticated smart contracts on the first layer of their distributed network. This include first-generation cryptocurrencies, such as Bitcoin, Litecoin, and Bitcoin Cash. Utility coins and tokens that enable smart contracts are considered second-generation cryptocurrencies. Smart contracts are automated contractual agreements that are stored by a group of different computers controlled by often conflicting parties and strangers. This group includes coins such as Ethereum, EOS, and Stellar. The third generation of cryptocurrencies are stablecoins. Stablecoins are normally ERC-20 tokens built on top of Ethereum's blockchain that maintain relatively stable purchasing power over time in terms of real goods and services in the economy. Stablecoins include Tether, USDC, and also stablecoins issued on public and permissionless distributed network like MakerDAO Psi. Privacy coins are an offshoot of the first-generation cryptocurrencies. They are often volatile in price and have additional features that obfuscate information about each transaction, including the wallet addresses of the sender and receiver and the transaction amount. This includes coins such as Dash, Monero, Zcash, Beam, Grin, and Mimblewimble coin. Table 1, Coin Categories: Store of Value, Bitcoin, Litecoin, Bitcoin Cash Utility, Ethereum, EOS, Stellar Stable, MakerDAO DAI, Tether Privacy, Monero, Dash, Zcash, Mimblewimble coin. Once we know which coins are demanded for which use cases, we need to calculate the demand for each use case. The values for each target market can be additive or cannibalistic, meaning there can be either dual demands on a single supply or the demands are mutually exclusive and should not be added. Table 2 presents the assumed TAMs for cryptocurrencies including remittance, tax evasion, offshore accounts, store of value, online transactions, micropayments, STO and ICO funding, crypto trading, gaming, online gambling, unbanked, consumer loans, unit of account and medium of exchange, and reserve currency. Technology evolves in a 14-year cycle around advances in computing power 54. Mainframe 68, Microchip 82, PC 96, Internet 10, MobileNet 24, TrustNet. Imagine investing in $IBM in 50. Fairchild in 64, $MSFT in 78, $CSCO in 92, $AAPL in 06. That's hashtag Bitcoin today. Mark Yusko, Morgan Creek Capital Management, April 2020. To project the TAM of future years, a reasonable assumption about the growth of this market going forward is required. This paper assumes a compound annual growth rate for each TAM. Some of the categories listed above lack reliable CAGR data. For those, we have assumed an estimate based on the CAGR of the S&P 500 index over the period from 2000 to 2018 because a reasonable assumption of the growth rate could be the long-term growth of the world economy. Furthermore, we believe that some of the CAGR values for the other categories might be inflated due to the long bull run over the last 10 years. A well overdue market correction is likely to drive them down at least by 2030%. The coronavirus V-shaped recovery is obviously sustained by devaluing fiat currencies, which itself isn't sustainable. Therefore, the market capitalization for each TAM is most likely an upper bound. PQ is normally measured as gross domestic product, GDP, in traditional economic models. However, speculation on financial assets is normally left out of GDP metrics. Foreign exchange volume isn't included in GDP, for example. Estimates that approximately 30% of a cryptoasset's on-chain transaction volume comes from investor speculation as they transfer cryptocurrencies between exchanges. Therefore, calculating PXQ by on-chain transaction volume is a noisy signal. Also, forecasting PXQ in the future by transaction volume today has a large estimation error. Instead, focusing on the target addressable markets and the growth in those markets is a better estimate. Table 2, Target addressable markets for cryptoassets in billions of United States dollar. Target addressable market, unit of account and medium of exchange 7, current capitalization, 126,800, implied 2020 end of the year capitalization, 136,094, implied 2029 end of the year capitalization, 187,101, CAGR data, 3.60%, applicable coins, stable, store of value. 2. Target addressable market, consumer loans 8, current capitalization, 42,263, implied 2020 end of the year capitalization, 46,489, implied 2029 end of the year capitalization, 71,381, CAGR data, 4.9%, applicable coins, stable. 3. Target addressable market, offshore accounts 9, 10, current capitalization, 19,000, implied 2020 end of the year capitalization, 19,684, implied 2029 end of the year capitalization, 27,061, CAGR data, 3.6%, applicable coins, store of value, stable, privacy 4. Target addressable market, reserve currency 11, 12, 13, current capitalization, 11,737, implied 2020 end of the year capitalization, 13,290, implied 2029 end of the year capitalization, 23,247, CAGR data, 6.4%, applicable coins, store of value 5. Target addressable market, store of value 14, current capitalization, 7,070, implied 2020 end of the year capitalization, 7,112, implied 2029 end of the year capitalization, 7,307, CAGR data, 0.3%, applicable coins, store of value 6. Target addressable market, online transactions 15, 16, current capitalization, 3,403, implied 2020 end of the year capitalization, 3,869, implied 2029 end of the year capitalization, 13,971, CAGR data, $13.70, applicable coins, all 7. Target addressable market, remittance 17, 18, 19, current capitalization, 706, implied 2020 end of the year capitalization, 755, implied 2029 end of the year capitalization, 1,389, CAGR data, 7%, applicable coins, stable, store of value 8. Target addressable market, micropayments 20, current capitalization, 617, implied 2020 end of the year capitalization, 934, implied 2029 end of the year capitalization, 6,020, CAGR data, 23%, applicable coins, all 9. Target addressable market, tax evasion 21, 22, 23, 24, current capitalization, 600, implied 2020 end of the year capitalization, 769, implied 2029 end of the year capitalization, 1,346, CAGR data, 6.4%, applicable coins, store of value, stable, privacy 10. Target addressable market, unbanked 25, current capitalization, 380, implied 2020 end-of-the-year capitalization, 388, implied 2029 end-of-the-year capitalization, 429, CAGR data, 1.1%, applicable coins, store of value, stable, privacy 11. Target addressable market, gaming 26, 27, current capitalization, 149, implied 2020 end-of-the-year capitalization, 181, implied 2029 end-of-the-year capitalization, 397, CAGR data, 10.3%, applicable coins, utility 12. Target addressable market, online gambling 2,829, current capitalization, 50, implied 2020 end-of-the-year capitalization, 70, implied 2029 end-of-the-year capitalization, 149, CAGR data, 8.8%, applicable coins, utility, privacy 13. Target addressable market, crypto trading 30, 31, current capitalization, 18.25, implied 2020 end-of-the-year capitalization, 20,665, implied 2029 end-of-the-year capitalization, 36,147, CAGR data, 6.4%, applicable coins, all 14. Target addressable market, ICO funding 32, 3,334, current capitalization, 7.3, implied 2020 end-of-the-year capitalization, 7.8, implied 2029 end-of-the-year capitalization, 14.6, CAGR data, 6.4%, applicable coins, all 15. Target addressable market, STO funding 3,536. Current capitalization, 0.57, implied 2020 end-of-the-year capitalization, 0.61, implied 2029 end-of-the-year capitalization, 1.1, CAGR data, 6.4%, applicable coins, all target addressable markets of crypto assets. This section describes the main use cases of cryptocurrencies. Store of value, remittance, tax evasion, offshore deposits, gaming, online gambling, providing financial services to the world's unbanked, lending, online transactions, medium of exchange and unit of account, reserve assets, micropayments, crypto trading, and ICO and STO investing. Mall of America in Minnesota announced it will miss second payment on its $1.4 billion mortgage. An intelligent question is, who is not getting paid? Dominoes starting to fall. IMF says debt will rise from $6 trillion to $66 trillion by end of 2020. Buy gold, silver and Bitcoin. Robert Kiyosaki, May 2020. Medium of exchange and unit of account. A medium of exchange is an intermediary instrument or system used to facilitate the sale, purchase, or trade of goods between parties. For a system to function as a medium of exchange, it must represent a standard of value. Using a medium of exchange allows for greater efficiency in an economy and stimulates an increase in overall trading activity. In a traditional barter system, trade between two parties can only happen if one party has a commodity that another party desires, and vice versa. The chance of this happening simultaneously is a cross-occurrence where each party desires something that the other party sees improbable. Thankfully, with a medium of exchange, such as gold, if one party had a cow and happened to be in the market for a lawnmower, the cow owner could sell his animal for gold coins, which he may, in turn, use to purchase the lawnmower. The unit of account and medium of exchange markets are currently estimated to be around $126.8 trillion, 37 United States cents. We could argue that all crypto is technically a medium of exchange, however, none more so than Bitcoin being the primary cryptocurrency. If we consider all of BTC currently being used for this purpose, this gives us a current market penetration of 0.13%. Despite unprecedented quantitative easing, trillions of short-term credits to the repurchase agreement market, and lowering interest rates to zero, the US dollar index DXY barely moved. This means that the dollar can take a lot more abuse from the printing machines, before it starts to devalue against other fiat currencies. Also, the 5-year forward inflation expectation for the US dollar is sitting at a low 1.43%. This means that despite massive debasement of the US dollar, markets expect inflation to be below the Federal Reserve's target 2%. Fed Chairman Powell understands that he can print more, and most likely he will. Fortunately, the blockchain technology has reduced the cost of switching between currencies. Phone applications, such as Crypto.com, already allow people to earn interest on several different types of cryptocurrencies and stablecoins that represent different fiat currencies. In the future, people will be able to hold portfolios of tokenized currencies in their bank account and on their phone, and they will easily be able to exchange currencies by pressing a few buttons. When the Turkish lira is losing value, they will be able to switch into a safe haven stablecoin like a tokenized Swiss franc. When Turkish banks offer high interest rates to attract capital, people will be able to easily switch back to the Turkish lira in order to earn higher interest rates on their deposits. This is already possible due to the dollarization of public blockchains discussed later in this report in Tether or Not to Tether by Pascal Hughley. Gentlemen, you can calm down. The printing presses run day and night again in 3 shifts. Rudolf Havenstein, German president of the Reichsbank during the Weimar Republic. Hyperinflation. 19,211,923 offshore accounts. The Tax Justice Network estimates that governments lose $189 billion a year from $2,132 trillion in offshore accounts of private wealth. 38. The International Monetary Fund estimates tax evasion to be approximately $12 trillion a year globally. 39. The SATUS report analyzed the target addressable markets for the entire cryptoasset market and found that the total implied market cap to be $3.6 trillion by 2028 using a similar equation of exchange model to the one developed in this research report. According to the SATUS report, the major application of cryptocurrencies is offshore deposits. They estimate cryptocurrencies will penetrate approximately 91% of the offshore deposits market during the next decade. 40. They also estimate the offshore deposit market to grow because of capital controls, national debt, unpopular fiscal policy, and debasement of national fiat currencies. Although the SATUS report uses offshore accounts and tax evasion synonymously, offshore accounts can also be used for non-illicit purposes such as opening up a business abroad and earning income. Also, many multinational companies have reserves abroad in case of a banking crisis in their domestic currency. In a bid to protect their assets from financial calamity, institutional investors are embracing the use of offshore crypto deposit accounts. According to several estimates, offshore tax havens account for 10% of global GDP. 41 10% of global GDP provides the offshore account estimates in the Excel spreadsheet. A 3.6 compound annual growth rate is assumed in order to forecast the future GDP and growth in demand for offshore deposits. Reserve currency. Reserve currencies are foreign currencies held by central banks. When a country acquires reserves, it doesn't place the currency in general circulation. Instead, it parks the reserves in the central bank. The reserves are acquired through trade, with the acquiring country selling goods in exchange for currency. Reserve currencies thus grease the wheels of international commerce by helping countries and businesses conduct transactions using the same currency, a much simpler task than settling transactions involving different currencies. Their popularity is easy to see. Between 1995 and 2011, the amount of currency held in reserve increased by over 730%, from around $1.4 trillion to $10.2 trillion. Which country, central bank, will buy Bitcoin first? According to the Crypto Lark, USA will buy 10.3%, Russia will buy 32.3%, Japan will buy 24.7%, Switzerland will buy 32.7%. Reserve currencies are typically issued by developed, stable countries. The currency most commonly held as a foreign exchange reserve is the US dollar, which, according to the International Monetary Fund (IMF), comprised nearly 62% of allocated reserves as of late 2012. Other currencies held in reserve include the euro, Japanese yen, Swiss franc and pound sterling. The dollar, while still the most widely held reserve currency, has seen increased competition from the euro. The euro has grown from slightly less than an 18% share of allocated reserves when it was introduced into the financial markets in 1999 to 24% at the end of 2011. The IMF reports both allocated reserves, meaning that a country has identified the currencies held in reserve, and total foreign exchange holdings. The overall percentage of total holdings that are allocated reserves has fallen steadily over the years, from 74% in 1995 to 55% in 2011. Much of this shift can be explained by changing foreign exchange holdings in emerging and developing countries. In 1995, advanced economies held around 67% of total foreign exchange reserves, with 82% of these being allocated reserves. By 2011, the picture had been flipped on its head. Emerging and developing countries held 67% of total reserves, with less than 39% allocated. Emerging countries now hold roughly $6.8 trillion in reserve currency 42. Currently, reserve currencies sit at around 11.7 trillion 43 and no central bank has officially admitted to holding any cryptocurrency in its reserves. Store of value is shown in Table 2. The target addressable market for stores of value is over $7 trillion. 44. This figure mostly comes from the global market capitalization of gold. However, people also store value in fiat currency. The US dollar alone has a market capitalization of $3.8 trillion, which is 20 times larger than Bitcoin's market capitalization. People also store their wealth in stocks and bonds and real estate, so $7.07 trillion is a lower bound on the largest target addressable market for cryptocurrencies. When it comes to store of value, the go-to cryptocurrency seems to be Bitcoin. If we consider that store of value seekers don't move their Bitcoin often, we can see that around 11 million BTC have not moved in nearly a year. 45. It is worth nothing that this amount inevitably includes some lost keys. As of the time of writing this report, this accounts to around $98.6 billion or a 1.4% penetration. The majority of Bitcoins have been held for more than 6 months. This provides evidence that the main use case for Bitcoin is not speculation and day trading. Some critics of cryptocurrencies argue that cryptocurrencies aren't used as a store of value. They argue that cryptocurrencies are only used for day trading and speculation. A good measure of whether coins are used as a store of value or for short-term speculation is the age of each coin. The average age of 20% of all of the Bitcoin in existence have been held for over 5 years. 46. We assume that these coins are being used as a store of value. The majority of Bitcoins have been held for more than 6 months, which provides evidence that Bitcoin holders aren't using Bitcoin for day trading but are rather holding for long-term appreciation. Factors promoting crypto use and adoption as a store of value include scarcity, transparency, global availability, pseudonymity, and immutability. One of the factors contributing to a rise in popularity is the fact that most digital currencies have a finite supply, resulting in scarcity. Currencies controlled by central authorities are often subject to arbitrary inflation, especially in emerging economies. Fulkenstein and Lennon 2016. Paul Tudor Jones, who runs the Tudor BVI Fund, holds a low single-digit percentage of its assets in Bitcoin futures, because of the massive fiscal spending and bond buying by central banks to combat the coronavirus pandemic. By his calculation, $3.9 trillion of money, the equivalent of 6.6% of global economic output, have been printed since February 2020.